morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, as earnings season continues, we cast our eye once again on the banking sector, and in particular, two of the Canadian-owned banking giants, Scotiabank, Trinidad and Tobago, and FirstCaribbean International Bank, that is, for their financial years ended in October. Let's turn quickly to Scotiabank, and for the financial year ended, as we said, in October 2018, Scotiabank reported earnings per share of just around $3.65, which is a modest 2% decline from the $3.73 reported in the prior comparable year. Now, in terms of good news, total revenues were up just around 6.2% from $1.7 billion to just around $1.725 billion to $1.83 billion, that should be. However, non-interest expenses did increase some 7.5%. From $685 million to $737 million. Now, the income before tax was up marginally from about 3%, from 934 to just about 963 million, but a high effective tax rate ultimately brought down profits after taxes just around 2%, from $657 million to just around $644 million. Now, Scotiabank's revenue trends have been and continue to be quite positive. And as we can see, retail, corporate, and commercial banking in this purple color part of the graph continues to grow from $1.3 billion in financial 2015 to just around $1.65 billion in fiscal 2018. The insurance services segment has also grown after stumbling over 2015 to 2016. It has increased from around $153 million on a consistent enough trend to just around $165.4 million. Now, importantly, in late November, an announcement was made regarding an agreement between Scotiabank and Sagicor regarding the sale of its Trinidad and Jamaica insurance operations to Sagicor, and that sale is expected to be completed sometime in 2020, pending approvals, of course, which means that Scotiabank's core business will now become pure banking as opposed to banking and insurance. Now, in a continued testament to Scotia's good management, despite that consistent growth in revenues, we see that non-accrual loans to total loans remains quite stable, increasing marginally from just around 1.75% to just around 2.3% in its most recent financial period. So again, a testament to Scotia's sound lending practices. And at its current price of just around $64.74, Scotiabank is trading at a price-to-earnings multiple of just around 17.7 times and offers investors a quite attractive dividend yield in the banking sector, the highest, of course, at around 4.63% compared to that average of just around 3.78% for the sector. So with reasonably attractive valuations from a dividend yield perspective, but above average valuations in terms of a price earnings perspective, and some flatness in terms of its income or income after tax growth, Bourse maintains its neutral rating on Scotiabank. And turning quickly to FirstCaribbean International, for its financial year ended again October 2018, the bank reported earnings per share of just around 42 cents, which was a very significant 30% decline from the 59 cents reported in the prior comparable period. Now, like Scotiabank, total revenues did increase just around 6.2% from $3.7 to $3.9 billion. But the main driver of this reduced performance was the credit loss expense on financial assets. And much of this was related to the government of Barbados restructuring on its debt, both Barbados dollar denominated as well as US dollar denominated. And that led to a 316% increase on credit loss expenses, from around $166 million TT equivalent to just around $692 million TT dollar equivalent. Now, adjusting for these one-off, or what we expect to be one-off expenses, earnings per share for FirstCaribbean International would have actually increased modestly, just around 4%, from 63 cents on its adjusted 2017 figures to just around 66 cents in its 2018 figures. Now, like Scotia, similarly, revenues continue to have an upward trend, moving from just around $3.5 billion in financial 2015, that's $3.5 billion TT dollar equivalent, to its current level of about $3.9 billion. However, as we can see in the yellow part of the graph, profits before taxes have been somewhat inconsistent and rather volatile on account of these one-off items. And again, in 2017, there was over $1 billion recorded in profit before tax, which has now declined to just around $632 million on account of the Barbados story. And just to give some context about how significant the Barbados exposure is for FirstCaribbean, as based on the 2017 annual report, Barbados accounts for just around 34% of FCI's revenue and about 37% of its total liabilities and just around 40% of total assets. So not an insignificant amount, or certainly a significant amount of exposure to Barbados, and hopefully that will all be behind them in the coming financial year. Now, at its current price of $8.30, FCI is trading at a price-to-earnings multiple of just around 19.8 times and offers investors a trailing dividend yield of just around 4.1%, which is quite attractive considering that these dividends are paid in US dollars. So on the basis of improving revenue, but tempered certainly by the Barbados exposure, Bourse maintains its neutral rating on FirstCaribbean International. That's it for this week's report. For more information, give us a call at 226-8773 or to Bourse. Email us at invest@boursefinancial.com or visit our website at bourseinvestment.com. Have yourselves a wonderful investing week. This has been the Bourse Report.